Hello and welcome everyone for another one of our weekly talks here at StashAway. I have with me again our Chief Investment Officer, Freddy.
Hi.
And today we're going to cover quite a few topics. A lot has happened on the trade front this week, right? The Chinese delegation went over to the US for talks, and I think even Donald Trump went into the meeting last night. So we'll cover a little bit of what's going on the trade front. We also have some remarks by the Federal Reserve and see how they impacted markets, because markets had a fantastic January actually, right? I think it's the biggest surge in a January since 1987, I think, or something like this I was reading today. And then we'll also cover a little bit about, with the market now moving in the right direction, like what could be like some of the challenges that people see in their portfolios with their goals and things like that. So Freddy, let me open it up to you.
Trade?
Yeah, let's start with trade. Let's go.
Yes, there's some encouraging signs.
Yeah.
In particular, today in Asian time, China Xinhua news agency came up with a report claiming productive progresses have been made with the US. Things are progressing well. Lack of details, but a lot of hoorah. So I guess the market likes that. The problem is, we think that fundamentally the trade war is not about trade. Mm-hmm. It's a lot about intellectual property rights. It's a lot about of a miniature sort of a version on a Cold War. So that may tore into March because things are looking good. But as I want to caution our investors, stick to your plans.
Yeah.
Contribute as per your plan says, as per your risk level says, regardless of whether it's really good news today or bad news tomorrow. Because the last thing we want to see people doing is to buy at a high and sell at a low by reacting to it. That's really a bad decision for long-term investors. So I just want to point out that the fundamental investment philosophies remains unchanged, regardless of whether the trade war is going to really get resolved or not.
Yeah.
And in particular, we do think that we'll first have a face-saving deal in March, as I mentioned many times.
Yes, which it seems like it's more important now for the Chinese as well, right? Because manufacturing numbers and numbers in general are trying to putting a little bit more pressure on the Chinese government, right? Just kind of how Trump and his
they even vowed to buy a lot of U.S. products to really reduce the trade deficit. So the Chinese are really caving in. They needed it, and so Trump's policy sort of work. But the thing is that from the political game theory perspective, towards the later half of 2019 and into 2020 general election in the U.S., you never know what would come up again as a political game, where somebody need to pick a fight again and try to win concessions again. So these things will not be like truly resolved, like really resolved forever. Yeah. So investors are just better off not reacting to it. Just stick to your plan. Whether it's good news today or bad news tomorrow, just avoid buying high, selling low.
Yeah, good, very good points there. And to wrap up like markets and kind of the news in general, the week. What about the Federal Reserve? I think this on Thursday, right, is really what drove markets a lot higher, right?
Well, the Chinese cave in, and the Fed has also caved in. The trade war sees the Chinese cave into the U.S., and in the case of the Fed has caved into the markets over December. From my personal perspective, I do not welcome the Fed's very fuzzy communications. It's truly a communication problem at the Fed. Their policy has never really changed, right? They hike rates gradually. It's always been the case. What scares the market and what the market really cared about in November and December, when we had a lot of sell-off, was the autopilot wording on how the Fed will sell assets on their balance sheets. Yeah. As you know, if you step back during the crisis in 2008, the Fed has bought a lot of assets, accumulated to about $4 trillion. The
QE program, right?
The QE program. Yeah. And now, as we exit the QE programs, because times are better now, and there's this autopilot program where the Fed is scheduled to sell about $50 billion of assets per month. Now, autopilot is what the market really hates because it signals inflexibility to adjust to future economic conditions. But the Fed has effectively caved in on this by saying, well, we are going to be totally flexible even with the balance sheet reduction. So the markets love it.
Yeah.
And
nothing changed in the short term, but yes, those items help, right?
Exactly.
Yeah.
But again, let's not overreact to this sort of short-term events as well, because you end up buying high, selling low again.
Yes, and I think that's the next topic we kind of wanted to discuss, right? We we got a lot of questions also from users, but even when I speak to family, right? It always comes up, right? If you have goals set up in life, right? Everyone has goals, right? And I encourage everyone to think about your goals, right? Especially at the beginning of the year, is a good time to take inventory and kind of what are you saving actually for, right? And what do you want to achieve in life? So what then is a plan that you can put in place so that you don't let human behavior dictate your investments, right? And that's what a lot of times what happens in personal wealth, right? If people just they overreact. The news, it's always there, right? So can you maybe give us a little rundown?
There's really two components to resolving this, and on the first one, and I think I reiterated a few times earlier, the mentality of buying high, selling low. And it's very common when things are good in the short term, people felt confident, and the media has become more and more effective and efficient these days with chasing the trend. When you have the markets performing well, you suddenly get a slew of really good news and articles that's already written so quickly, to the point where I actually felt, are they optimized? As you knew, right, Brexit or not, into the event, the media had two versions for the front page.
Of course.
Brexit or Remain, they will have a story for either scenario. So the media's job is actually not to help you make a judgment, but it's just to inform you whatever is happening. And due to technology and social media, we now get a lot more.
It's instant, right?
Instant.
Yeah.
So it actually makes the challenge for investors bigger these days than before. And ends up, it's quite common to see a slew of good news everywhere in all sorts of media channels when the markets are up, and end up people are buying at a high point. This is called fear of missing out syndrome, FOMO.
Yeah.
And on the way down, you suddenly see a slew of doomsday scenario and articles that just come up from nowhere, and you just flood all of the channels that you ever looked at. And then you felt like the world is ending, and you started selling at a low point.
Yeah.
And that has really been proven just by the data to be extremely costly for investors.
No, and I think it goes on both sides, right? Like the same also when the market is having only bad news, right? Like in October and things like that, we always said, remain in your plan, right? Keep putting the money in that you need for retirement, that you decided on, I can save every month, right? Nothing about that changed, right? Especially if your goal is 10, 15, 20 years away from now, right? I think there's some really good saying, I can't remember who it was, but right, if there's blood in the streets, right, it's time to buy, even if it's your own.
Yeah, Warren Buffett himself says sell when other people are greedy, buy when other people are overly fearful.
But it's very difficult for humans, right? So this is the one thing, right? What makes everything so difficult, because we as human beings, we have the tendency to evaluate something that happens bad to us like exponentially more than the good things, right? So we look at them all losing something. It's much harder for us to process than actually how much happiness we get from wins in terms of the market.
Which is why I think investors need to pay close attention to what it really means by the word dollar cost averaging. Now, most people think about their investment portfolio as of right now because they think about lump sums. Like, all I have today is one trade. Oh, the market is up. Great. Oh, the market is down. Oh, no. It's really a one trade mentality. It's a lump sum mentality. But most of us, you wouldn't invest 100% of net worth in the market, would you? Most of us should have a plan where through monthly income, less expenditure, right? From my spending habits, I create savings, and I invest those savings regularly. For example, on a monthly basis, right? As per how we get paid.
I think this is one of the reasons why there is StashAway and the way StashAway was actually built. When I joined, and that was one of the great things, is that we actually have goals, right? So, we have goals, and you can, when you first get to the platform, you might think, I can only add one. I know, but you can have as many as you like, right? It's based on your preferences, right? Some of my colleagues, they have 6 goals, right? They have their retirement goal, they have one for buying a house, they have one for their one child, one for the other child, right? They have a safety net, which is like lower risk. But for each of them, we ask really specific questions, right? And they're tied to your risk profile and also tied to your
It's tied to the goal,
yeah.
the time period of the goal. For example, the longer the time to the goal, say for example, I want to retire in 40 years time, because I'm young, then you could have taken more risk because there's more time to recover from short-term swings, and you have more time to compound. But if you have to make a down payment for a flat next year, there's only 1 year time. So you got to rely more on your savings ability, your spending habits to create those savings than rely on the market as much. Because the last thing you want is to have a big drawdown, not enough time to recover. Down payment time, it's not a 3-bedroom flat anymore, it's a studio, right?
Exactly.
So I think the goal time, the goal setting is really important.
Yeah.
And something is wrong if you are checking your app, you every single day, 5 times a day, and you have a 30-year retirement goal. That is something went wrong there,
yeah.
right?
No, absolutely. And I think those are like some really key points, right? Like, if you like to learn more, right, we do a lot of articles as well on our Inside blog that we also cover this actually extensively. And if you have any questions, if you listen to this over the weekend or even next week, happy for you to write them in the comment section, and Freddy and I will certainly address them over the next few weeks, right?
Yes.
Okay, well, hey, thank you so much. I hope you have a wonderful weekend, everyone. And we will certainly speak to you next week.
Yeah.
Bye.
Bye.